Ladies and gentlemen of the crypto space, we're live on Wednesday, July 20th at 11:28 a.m. We're on time. We got a good story. People are always interested in stable coins. I've talked about them before, but I think it warrants a recap, obviously. Coming off the most bearish part of the most recent downturn, but it's been a long bear market, long depreciative cycle, months, 8 months, give or take, something like that. And these types of conversations will help us better understand how markets work, why they work, the meaningfulness of them, what the technology is, what it does, what it promises, what it's capable of. And it should allow us to be more comfortable with interacting with different types of stablecoins that have done relatively well, especially amidst the UST meltdown, well, complete collapse for that matter. Um, we'll keep it very simple. There's one prevailing stablecoin protocol implementation that works, and it works because of historical precedents. It's the Eurodollar. And the Eurodollar is a CDP. It's a collateralized debt position where dollar-denominated assets are used to mint into existence a dollar dollar value asset, euro dollars. And aside from the complexity of how the Eurodollar system works, which is not my specialty, conceptually, highest of levels, that is what it is. So what happens if you have volatile, volatile assets with volatile price points used as collateral? The price point goes up and down. If the collateral backing the position size, $1 million collateralized by $1,100,000 worth of assets. If the value of the assets drops to $1 million, probably get a margin call. And if the value drops to $950,000, the issuer of the Eurodollar begins liquidating assets to make the position whole. It's probably not 950. It should be a million. If your collateral drops to less than what you borrowed dollar value wise, you should start liquidating assets to maintain the balance sheet. So that makes the most sense with regard to why CDPs have worked in the crypto space, because that's exactly what they are, except the Eurodollar system uses historic banking infrastructure, whereas the crypto space uses deterministic smart contracts to facilitate the liquidation process. And this is not Aave, but Aave you're borrowing not, well, you can borrow stable coins, but so in that regard, this is why Aave facilitates the historic commercial bank money creation process. If the collateral value drops below the liquidation threshold, it gets liquidated, which balances their books. It balances the balance sheet. Who are the issuers of stablecoins that use CDP protocol uh, ideology? Um, uh, Historically, MakerDAO, Tether, ChiDAO, uh, Abracadabra. Is that all? Because Frax is in a different, fits very different qualifications with regard to what they do. It's a collateralized deposition in regards, but it's much more. And then we'll get into that. They're in a separate category. But the biggest take home is understanding that Tether, aside from business complexities and traditional complexities from a corporate compliance and transparency and business operation standpoint, what they do is not magic. There's no such thing as a printer. It doesn't work like that. It's not a damn printer. What they're doing is taking dollar denominated assets and minting a dollar valued asset. It's a damn euro dollar. There's no magic there. There's no mystery. And this is completely neglecting potential complexities from a business perspective, which is separate and apart from what they're doing practically. So I'm not worried in that regard. So there, in crypto, there's the value of the asset being effectively collateralized and the efficiency of the liquidation engine to balance the balance sheet. And then there's also the peg. So there's two components to a successful stablecoin. The peg plays into lendiness, plays into trust, faith, because obviously if peg breaks, people are scared, they don't believe in it, they go to sell it, and that creates the historic bank run, which is what took down UST. They weren't capable of maintaining the peg, trust was lost, and everyone tried to get out of it at the same time. So what's required for a functional stablecoin is domination of the peg, a complete capacity to ensure that the peg is maintained under all conditions. So Tether and the other CDPs have their liquidation engine, but they also rely on arbitrage, which is it's basically incentivizes people to restore the peg because there's a potential for capital gains. Um, if you buy Tether at 96 cents and it goes to $1, you're able to sell it for a 4-cent profit. So that I think carries risk. Um, they have their redemption mechanisms, and the stability protocols where you could redeem and mint to aid in addition to arbitrage, but it's not a perfect solution, and there will be slight slippage from peg at times with all the CDP protocols, which is exactly what we've seen. But they've been very effective. Look at Abracadabra, who survived. Now, bear in mind, Curve plays a big role in this because of their monetary policy and their capacity to incentivize participation in LP positions, as well as their what A parameter, and which generates various levels of arbitrage opportunity to restore a peg. So that's a third party critical component to the effectiveness or how uh, resilient a stablecoin is. Um, so I like CDPs. I think that's a big deal because history has shown us that that's a critical component of monetary expansion. You need monetary expansion for growth, and that's exactly why the global financial system is completely dependent on the euro-dollar expanding for growth to actually occur. And this is the entire story that Jeff Snyder and his and his crew talks about. Um, Aside from that, Frax is in a whole nother league. Frax piques my interest more than all the other CDPs, particularly because, to my understanding, they dominate the peg, meaning under all conditions, the amount of Frax owned, the amount of LP position owned, in at least mainnet Curve, um, by Frax, um, they if every Frax in circulation is sold by public holders to using an AMM or an aggregator or Curve directly, Frax has a capacity to remove that quantity of Frax from the LP position, maintaining the peg under even a complete liquidation of all Frax from circulating supply, from all retail holders' hands. And that means everything. That means they've dominated the peg, which means that over time, lendiness will build, especially in market turmoil. As the protocol survives market turmoil, it builds more and more trust over time, which means they'll be able to get away with a lower and lower reserve, which means they'll have a larger and larger treasury, which means the treasury will be more productive, it'll produce more revenue. It's a cash flow positive protocol. And that's what piques my interest so much. It's more than just a stablecoin, it's really a central banking operation, which is exactly what Sam would define it as. It's a functional treasury. It's cash flow positive. They have peg domination, and there's absolutely no reason there's an issue backing it by USDC. Sure, you have the centralization or the consolidation of the backing by a single asset, so that introduces an entire conversation, getting away from a single point of failure, USDC. Um, is something to always discuss. But I would have no issue with 100% backing by USDC, 100% reserve, um, because then it would be a 100% backed stablecoin with a monetary policy on top, the FXS monetary policy, which is Treasury generates revenue, and they're able to throw around FXS to incentivize user behavior. Plays into another topic about incentives. So the purpose of a stablecoin is sure to hold a temporary as a means of temporary store of value, but demand for a stablecoin drives its growth. So Frax, with its treasury, with its incentive systems, and its ownership of a good part of the Curve incentive system vis-a-vis vis-a-vis Convex as well as Curve, allows them to create a demand for the minting of Frax. So their capital creates the pressure, which drives the cycles. Um, I forgot one other stablecoin, one other CDP, which is Synthetics, is actually the original. It's one of the first protocols in late 2019 to really catch traction, and they really are the foundation for a good part of the entire DeFi space. Let's pop it over to the main screen so I can at least look at a chart while I talk. Synthetics does the same thing, but it's different. So obviously, each one of these stablecoin protocol implementations has its unique characteristics. Synthetics has a liquidation engine. You get margin calls, and it has its liquidation thresholds. It's you have time, so there's a 12-hour liquidation window if the collateral is not, if you don't have enough SNX to collateralize the amount of SUSD that has been minted, and you could burn to balance the collateralization ratio, which is basically a forced liquidation or a voluntary liquidation. Um, so these are very interesting characteristics. I actually have always had a high opinion of Synthetics, and coincidentally, that was the position I mentioned a little earlier that I took, particularly because it has a diamond pattern, it has a diamond bottom, and this very interesting price point. And there's a shortage of SUSD on Optimism. The pools are light on SUSD, so SUSD is actually over $1, at least at the AMM level. Probably not the protocol level, but at least at the AMM level, which means there's an arbitrage opportunity, which means there's going to be a demand for SUSD. And how do you get SUSD? You got to buy SNX to mint SUSD. So that's an incentive. There's an incentive to purchase SNX to balance the pools, especially for a large actor who's able to capture percent on a large capital outlay, like $5 million. If he captured 2-3%, that's massive, big deal. It's a good salary for a day. It's a good hard day's work. Um, and also is the entire Synthetics ecosystem, as well as the revenue it generates. So it generates revenue. It's a cash flow positive. It's actually flip flopping back and forth with Bitcoin with regard to being more cash flow positive with regard to transaction fee revenue. And what's the incentive to have SUSD? It's to and SNX for that matter, is to operate in their options ecosystem and their Synthetics ecosystem. So there's a demand for it, there's a use for it. It's cash flow positive, so there's incentives that incentivize the use of it. And there's a great deal of lendiness because it's been around strong since late 2019. And that's meaningful. So all these components contribute to how I look at the space and when I consider taking a position. Very picky nowadays. And that was enough to warrant me taking a little something, which is rare. I think this is the seventh position I have, seventh major position. Other ones are relatively trivial. Um, that's cool. And I like what I see. I think the market looks relatively strong amidst a catastrophic macro backdrop, which probably entails a bear market rally. How do you have a strong, what is a strong risk market in a macro backdrop that is catastrophic? What does that mean? It's not like you have a strong economy, but if risk assets are going to perform well, these are the assets that I would like to possess. I'd like to have in the portfolio, the ones that are outperforming, the ones that are most productive, and I think that's what I've crafted with the chosen assets I have in the portfolio. Um, we're not going to digress too much into portfolio construction, but the stablecoin topic is a topic I always like to talk about because too many folks don't understand how they work. So many folks, every time Paolo says $1 billion available of USDT, everyone's like, "Ooh, the printer's running." In some regards, actually, it's true because it's capital expansion, it's collateralization of a debt position, and someone's going to be providing collateral to mint or acquire minted USDT. But it's not what people think it is. It's not just magic money that comes out of nothing. It's a historic process. This is traditional Eurodollar stuff. It's the way it works. Where do you think they got the idea from? I mean, shit. Christ. The amount of insanity that goes on in social media and the crypto space is beyond is beyond anything I really want to discuss. I mean, these folks don't literally do not have an idea what they're buying. But when you have an idea what you're buying, you're like, oh, this is actually quite interesting. Oh, there's a history. Oh, this stuff actually plays into macroeconomics. Not the speculative part of the crypto space. There's actually components in the crypto space that have significance with regard to the way things historically worked in macroeconomics. Whew. Let me answer some guys' questions. Let's see what I can do to help. Crypto Bets, top of the morning, Captain. On the Zoom call, but listening to some rational Captain talk. Stay rational all the time. That's what we do around these parts. Maker, is there any protocol that offers stables as bribes? Some folks are throwing around bribes on Aura, stable denominated, which is pretty cool. Um, it depends. Some bribe is basically a payment. It's a capex from a protocol to uh, influence monetary policy or direction or targeting of the monetary policy. And we talk about this most often with regard to the Curve Federation, but now we get to talk about it with regard to the Balancer Federation, which is pretty cool. Um, these are the two prevailing federations, and Balancer still has a ways to go. VLR is still has less strength, carries less voting weight as compared to VE-BAL. So that's something to consider. The Federation is still very nascent, especially as compared to how robust the Curve Federation is. So that's a good part of my entire crypto narrative of how strong or the meaningfulness of a federation. That's everything. It's everything in finance. It's the same thing as a federation of nations, an organized group of nations that are acting together in a coordinated fashion to produce the best outcome possible. It's exactly what's happening with protocols. They're acting as federations, as a federation, and now one additional federation. That's cool. That's cool. You can have more federations. It's not one federation to rule them all. But that ensures that every protocol is supporting each other. There'll be constant buy pressure of these assets from protocols that are mandated to put them on the balance sheet for many different purposes. Well, Dan's in the house. Good morning. Trader Z, a pleasure. Off topic question: is it better to be proactive or reactive in these financial markets? Proactive is going to carry more risk um, with more return potentially, especially if the market turns bullish. And reactive is obviously less risk, more confirmation, less likelihood of potential loss. It's good to be both under different degrees of market conditions. Um, I mean, I really like this pattern. This is a diamond bottom coming off significant depreciation. I mean, the last time synthetics ripped, it was very big rip. But we've had a long leg of depreciation since the top and double peak, but this was trivial in May of 21. But this is DeFi summer, February 2000. Well, this wasn't DeFi summer, but February 2021 was the peak. Um, but it's a nice low. It's a base. That's pretty cool. So we literally just bought up the base. I mean, if you put the line there, this was a blow off bottom below support. And this has just shown this is a heck of a period or a price level where persons are willing to purchase. Multiple times throughout history, it could not get below it. And when it did, it was ferociously bought. If you look at the wick actually right there, it's a massive buy wick. Someone said, whoa, it's below support. And look, this is a wick from one candle, one daily candle from $1.58 to 3 and change, 100%, 100% daily candle. That's wild to see. We'll look at the curve of the convex charts as well. Convex is stronger. This is basically an ascending triangle formation. I don't have the lines up. Curve looks very interesting as well. This was a massive 1 hour candle in curve land. Curve is volatile, but it doesn't have 100% rips necessarily. It's a very different asset considering the amount of liquidity that's out there. Basically, the capital flows in and out of circulating curve occur to a much lesser degree as compared to other assets for a variety of reasons. But this looks good to me, and it's irrelevant, the price point in most regards. And you could opt between curve and CVX as voting incentives. So bear in mind, curves throws around the largest voting incentives for the entire, bribe implementation. Curve voting incentives. It's good that they call it voting incentives rather than bribes because of the connotation. But bribe.crv.finance still has curve bribes, and that's cool. Or you could use the voting implementation, which you have access to convex, which is throwing out a fair amount of yield. Look at that, a penny on CVX FXS. That's wild to see. Big bugs. Good morning. Since one curious view, since topic of the day is stablecoins, what's your take on Aave stablecoin proposal? It's nothing new. It's just a new stablecoin. That's cool. We'll see what they come up with. It's not like it's going to do much of anything functionally different as compared to what has already been implemented. If anything, it's going to be a CDP. They're going to use the collateral that's available to back a stablecoin, or at least like if they'll allow you, the protocol will allow you to mint their stablecoin, maybe, and they could have a more favorable interest rate as compared to depositors or lending their stablecoin to you. So instead of borrowing DAI for 12%, you can mint, what was it, G8, GNO, whatever it is, for 5%. So people are going to mint it. And there's the collateral, and there's the stablecoin, which they minted instead of you borrowing it from the market. If anything, it should bring borrow rates down, which will allow for more money creation as per double entry accounting, and that will increase the available liquidity in the crypto space, which will be price appreciative across the entire space. Given that Aave is basically the bank of the crypto space, literally as per traditional commercial bank accounting practice. It's a bank, which is wonderful, especially given not it's a wonderful protocol, but I don't think it's a good investment. At all. But if you notice, their front end is IPFS hosted. Their contracts are immutable. So it's a damn bank. What is any regulator going to do? No regulator is going to do anything about it because they can't technologically, and that's a big deal. Tapsy, morning. Zoidberg's in the house. Alessandro, hey Noah, great content. Given the change in trend of the risk markets, what levels would you be looking at to enter and deploy capital in curves? Sure, I was actually talking about this with a colleague. I'd probably say what I said to him was if you have no position, you start getting a position. You got to build positions, 1, 2, 3, 4, 5% of the target position size. Let's say you're targeting 5, 10% of a portfolio for the curve, for the crypto space, and you carve off 2.5%, or a certain, let's say it's 1, 2, 3, 4, 5% of your target curve size position. You start the DCA. You got to build a base position, and you can buy at any price. It doesn't matter. But if you see discount of like 60, 70, 80 cents, let's say macroeconomics takes hold and we have another liquidation. Let's zoom out to the weekly. So look, we're hitting TWAP resistance on the weekly. Look, this time period back here, you can't compare to this time period now. It's basically a different asset. It's a entirely different reality for the protocol. So it's completely not comparable. But from a price action perspective, you have a bullishness. If it breaks through the TWAP, great, groovy, grand. Let's say it finds resistance and we have a new leg down. Whole point I'm trying to describe in the moment, let's say it falls back down to 60, 70, 80 cents. That's where you take 30, 40, 50% of the position. And maybe you have another dip down, or maybe you hit your entire target position size here at 60, 70, 80 cents. Now that would be optimal. But I would probably buy a little bit now, like 1, 2, 3, 4, 5% of the target position. If you're going to throw around 10 grand, you buy a couple $100, $500 over the next 3 weeks. And if it starts to dip down, I would want my target position 60, 70, 80 cents. That would be optimal. And for me, I'm not too interested if the price doesn't go super high. We're not going to, there's a lot of folks that say 10, 20, $30. Great. If it happens, I'm not banking on it. I'm banking on at least the price not going down. As long as the price stays $1, $2, $3, it could stay at that for the next 10 years for all I care. So that goes into the entire curve narrative. I don't want to digress in that regard. We've talked enough about that. We're not going to delude the stream. Um, and secondly, since you see curve as a purchase, see, actually, okay, you're up to speed on the way I see it. That's cool. And your V curve decreases linearly over time. You just keep, yeah, I just keep relocking in perpetually. Yes, that is what I do. I see it as a purchase. And it's very interesting, folks will say it'll be diluted. Sure, according to max supply and the emissions rate, I get a 50% dilution over the next couple of years until, emissions levels off. There'll still be emissions, but it'll level off with regard to its very sharp increase. We're large emissions right now. It tapers. It's a disinflationary asset with regard to emissions. But if we're at $300, $400, $500 a day in transaction fees, and you go to $3 billion a day, yeah, okay, they can dilute it all they want. And I think 3 billion is going to be a relatively small number in the next 10 years. Why would we not speculate? So there's a speculation. The speculation is in the price point. To care less if this thing goes to $10. That would be awesome. But let's say you go to $30 billion a day in transaction fees in 10 years. You know what the damn protocol revenue fees are going to be? Just literally V curve transaction fee revenue. It's going to be wild. Killis, morning. How are you? One curious view: Star Trek fans will tell you there's only one, the United Federation of Planets. Yeah, well, there's a lot of federations even in Star Trek. Every damn civilization has a federation. But I see your point. Yes, with respect to competition, die. I like die, especially now that they're talking about collateralizing die with real world assets. They have that proposal with was a New Haven Bank, which is an actual regulated banking institution. That's awesome. So there's some very interesting things that they're doing as well. It's not lucrative. MKR has done horribly. It's great tech conceptually, uh, functionally, shitty investment. At least for my portfolio size, it's not productive. If someone with 50 mil, you could do 2, 3, 4, 5, 6% appreciation a year, and that's big for them. Different mentality, the way different portfolio size engage with the markets. Very different considerations. And you guys are here, so you get to hear my story of how I engage with the markets. I mean, frankly, this could be a relatively large falling wedge. That'd be very interesting. I should draw the falling wedge bigger. Let's do that. Let's draw from the bottom. Just for the fun of it. Bear in mind, this is 3 hits on resistance, and usually falling wedges have 3 hits on resistance, maybe a dip down and then a breakout. As we see time and time again, 3 and 3. But given market conditions, not necessarily going to get back down to support for a lower low. I mean, even in the great hyperinflationary collapse, you didn't have a lower low on the second dip down. Still had a higher high. Maybe 90 cents, maybe a dollar, and then the breakout, or horizontal, and you get just a boring breakout, and this thing just trends at a dollar for like the next 10 years, all eternity. Um, they're proposing the fees would be returned to the Aave holders. Oh, cool. So if Aave starts to be a productive asset and a dividend is paid, cool. That's lovely. And now it's turning into something that can potentially be considerable for a position. I don't care if something speculatively is going to be productive. I care what it is with regard to productivity today. So I can measure its effectiveness on my balance sheet today. And what I want is something that performs well today, that speculatively will perform better in the future. And that makes the most sense. Hono Zipbex. What, Bitbex is the hell? Don't know what it is, but I like it. I hope this answers some things regarding stablecoins, and that's literally one of the biggest narratives I talk about. I say stablecoins is probably the biggest narrative in the entire crypto space. It's Eurodollars, and Eurodollars is the largest currency in the world. There's more Eurodollars than dollars. And as Jeff Snyder says, it's basically the world reserve currency. It's just not talked about. It's shadow banking. It's behind the scenes. They don't talk about Eurodollars on a country's balance sheet. They talk about dollars. So Eurodollars, there's more of them. As Jeff says, there's probably quadrillions of them. So to me, things surrounding the stablecoin type narratives are probably the biggest thing in all of crypto, because that means they play into traditional finance. Like if the U.S. wanted to have an instantaneous CBDC, they could just collateralize GUSD or USDC with treasuries, as in treasury just prints treasuries, gives them to Tether. They probably won't want to do business with Tether, and prints stablecoins. That's exactly what these companies are designed to do. USDC is designed to take a bond and give you USDC. So they're completely already set up to print, to be a money printer for the Treasury. No Fed, no borrowing, no monetization, no bullshit shenanigans or, funny three-letter acronyms that the Fed has to create. The Treasury, Congress could just say, hey, Treasury, partner with this stablecoin provider and mint some damn stablecoins. And then that's how they can airdrop it to people. They basically give a government Ethereum wallet to say, here, it's on the Play Store and the Apple App Store. Everyone in the US download this app and there's your stable coins. And now they tell all the damn credit card terminals to update their software. So NFC tap to pay takes a stable coin. I mean, this is not hard technologically. This is hard conceptually with regards to the organization of capital, definitely the legislative process. But technologically, um, there's no complexity. Treasury already knows how to mint treasuries. USDC already knows how to take in collateral, manage collateral, and mint the USDC. We have proven over the last 2 years how to manage, ERC20 stablecoins. Now, all you have to do is have the terminals accept basically connections from Ethereum, uh, whatever, Polygon, Avalanche, Phantom, what have you, Arbitrum, Optimism. So you can have your stablecoins or whatever network you want and tap to pay, stablecoin payment. So technologically, there's literally no resistance whatsoever to this playing out. Just a matter of will at this point. Last question, and I'm going to wrap it up for today. Daniel, should I put my Ethereum to work or just Huddle? Hard for me to answer the question because I'm not a fan of owning Ethereum. I'm not a fan of owning Bitcoin. I'm not a fan of owning protocol or infrastructure tokens or whatever the hell you want to define them as. I have a high opinion of the monetary policy and that especially the transition that will occur to POS, but it doesn't fit my core narrative of I don't want to own money. I want to own enterprise. I want to own business. I want to own cash flow positive business. Now, what's the use of Ethereum is money. I need to own Ethereum money so I could pay for fees to operate my business. I need to have Ethereum money just in case somebody wants to accept Ethereum as payment. And they're like, how do you want to get paid? Pay me in Ethereum. I own a little bit of Bitcoin because I'm able to pay persons in Bitcoin that want to accept Bitcoin. It's not a lot. It's $500, $1,000, or someone wants Bitcoin. I have Bitcoin and I can pay them. So I hold currencies as a means of payment. Now, obviously, the prevailing currency, which I could pay for most things, is dollars, stable coins. I could use them on debit cards. And every schmuck in this country with a store, schmuck, including Target and Walmart, and so on and so forth, accepts dollars. So that is the most useful asset, the most useful currency. I'm able to pay for the most things with it. But that's the way I think of like Ethereum and Bitcoin. But I think Ethereum, if POS works out well, speculatively, we'll see. I have a high opinion of the monetary policy. It's going to be deflationary, whereas Bitcoin is only disinflationary over a multi-year cycle. But on the shorter time frame, it is an inflationary protocol. Most people very much mischaracterize the monetary policy of Bitcoin. Either they don't fully, at least see it the way I do, which is actually the way it is on a daily basis. Bitcoin is inflationary, but after the POS merge on a daily basis, Ethereum will be deflationary. There'll be less and less Ethereum every single day. Every single day, there is more and more Bitcoin, even after a halving. Every single day, there is more and more Bitcoin, even after the 4-year halvings. There's just less. So it's a disinflationary, less inflation over time. Whereas with Ethereum, after POS merge, every single day, there will be less and less Ethereum, never an increased supply under expected operating conditions. So that is food for thought. And I know a lot of people hold this stuff, and I know, like it's hard for me to try and tell a story, at least a story that I tell to the general public with regard to how do you get into this stuff and the whole DCA Bitcoin. But it just everything I've done over the last 2.5 years is really just trying to tell a story of money and value, and this whole preservation of value narrative drives me nuts. And because I'm not going to digress, but I don't agree with it. Value is going to fluctuate and value has volatility. So therefore, the whole goal with like Ethereum and Bitcoin is merely to capture the volatility. Who the hell didn't sell Bitcoin at 60 something $1,000 or says, oh, I should have sold it because I hodl Bitcoin and I need to get more and more of it? Yeah, if you didn't sell at 60 grand and buy at 20 grand, you missed the volatility. You didn't capture the volatility. That was a mistake. You would have preserved value better. But you missed it. You didn't capture the volatility. The preservation of value requires the capturing of volatility. And the lack of capturing of the volatility means you're not preserving value. So in order to be more sustainable over the last 2.5 years, I've defined a different narrative for myself. And it's not necessarily about value, but I focus more so on the concept of enterprise and cash flow. And I think in terms of a balance sheet, whereas the value of the business is not as meaningful as the cash flow of the business. As long as the damn business is printing cash, that's work, that's labor. Well, it's a result of labor, other persons putting in the work and effort to do the speculative trading and to engage with these digital forex markets. And I'm capturing that. And that is, to me, is what I've found comfort in as a more sustainable approach. Whereas I don't care if the portfolio goes up and down. What I care is at the end of the week, how much money did I make so I could buy food and pay rent and pay the mortgage and pay the car loans. I can actually pay for things. I've spent the last year really refining the crypto to actual real life flow. The debit cards, the bookkeeping, the QuickBooks, the accounting. Since January, I've done the accounting. I've talked about, trusts, and can even do it to some degree with corporations, but I think trusts are much more favorable with regard to what's possible. A much more favorable accounting practice and tax reporting obligations, deferring tax obligations. It's very powerful and much easier to be in compliance from a crypto standpoint. It's something I'll circle back around to and talk about. I think, but it's very technical, so it's not easy to implement, and it's often costly with the lawyers and the accountants. But if folks want, I'll circle back around to crypto accounting and taxes. So just let me know in that regard. One curious view. Jeff did a talk with that. Yeah, right. So he's talked about stablecoins. He had a real hard time grasping what Jeff was saying. So you see what I'm talking about? See, even Jeff probably sees what I see. I haven't seen his content, but I'm inclined to think he sees what I see in that regard. Um, don't you think owning POS validator would be cash flow positive, or just curve cash flow is more efficient? So I've had the thought of Ethereum validators, um, and the deflationary nature of the monetary policy. So they could be very meaningful cash producers, but speculatively, which I'm inclined to think Ethereum is going to appreciate significantly if there's going to be less and less supply on a daily basis. So I have a high opinion of that. So if you're going to go like an Ethereum route, I would opt for a validator, which means that quantities of 32, batches of 32, or maybe Rocket Pool, you could do 16. So I actually, all nodes has, I have two old nodes. I'll digress for 2 seconds, and I'll show you the all nodes portfolio. It's just two. It's just Syscoin and Firo, and I could probably fire up a four, but four is, I don't even know what the hell it is anymore. But Firo has survivability characteristics. It's survived for a long time, and it's still going. And Syscoin has an Ethereum virtual machine, so this is certainly it's surviving. Period. But it's a good provider. At least it's been around for years, 5 years or so at this point. And they offer rocket pool nodes. It's literally just, it's relatively economical as well, and it's click, point and click. I'm not too much of a fan of it for rocket pool and Ethereum because you have to deposit, and the reason I don't mind it at all with regard to like Syscoin and Firo is because I still have custody of the assets. They're just hosting the master nodes, old school master nodes. Oh goodness, those were good days. So it's just food for thought. They have Ethereum validators, but I'd probably want to run it on my own. But again, what has allowed me to make my decision to not own everything I want to own? It's not productive today. So what I want is things that are productive today. I'm adding things to the balance sheet that will be productive on Friday. In fact, synthetics will be productive today in about an hour, give or take. The epoch passed already. So if we go over to optimism, I should have staking, earn 1 hour and 14 minutes left. And I should have some nice yield at 104%. The position size I took, I should have a $500 claim, give or take, for a week. So it's productive right now. And that means everything to me, because if it's productive right now, I get a sense of where it's heading, especially after looking at the technicals, understanding what it is as basically a base layer to an options market ecosystem. And this goes into like me saying good things about GMX, but something about GMX not being on mainnet. So this piqued my fancy. Anyway, uh, that's the deal. Thank you all. Wednesday, July 20th at 12:13 p.m. As always, thank you all for joining me. I hope this helps. If you guys have a topic or something, I'm more than happy to talk on it. Otherwise, you know me, I shoot from the hip and I have something to talk about all the time. I wish you all a wonderful day. After party on Discord for the most rational community in the entire crypto space. I'm always in there. You guys are great. We make good decisions in there. I will see you guys next time. I will see you guys on Friday.